GM. GM. I want to talk to you about how money works. Because I think a lot of people aren't aware. When you're talking about owning assets like Bitcoin, if you're too involved, if you're too deep in it, you think about but what if it goes down 90% or 80% again? And what if it goes up and crashes? And when should I sell? Rich people don't think that way. Rich people manage their portfolio, usually through an asset, usually through a professional, or themselves if they're involved in finance. And the goal is never to hold cash. Ever. Cash is a liability on your balance sheet. Cash is a liability. That means holding cash has risk. The reason it has risk is because at every conceivable moment, in every type of market, there is always something that will outperform cash. If we are in a bull market, risk assets will outperform. So you want to own the stock market, S&P, NASDAQ, and in future, crypto. If we are not in a bull market, if we're in a brutal bear market and a recession, you want to own government bonds, because in a recession or in a environment where high interest rates have led to a recession, which is usually how it goes, you want to own bonds because you'll yield 3%, 4%, 5%, 6%, i.e. better than just cash. If you're in an inflationary environment, you want to own gold, right? And at every point, every type of market, cash is not king. You might be psyoped into thinking this by all the talking heads and by the elites that want to keep you financially illiterate. So they spread stuff like cash is king. Cash is king for about fucking 2 weeks a year. If you could hypothetically get into cash before a crash in the stock market, like in COVID, if you could get out before it goes down 30% or 50% or 60% and get back in, yeah, well, cash was king for those 2 weeks. But for the average person, it's not, because that's trading. So you were never going to get out before the crash, and you were never going to get back in at the bottom of the crash. Cash is not king. Cash is fucking trash. And the rich people know this, and they've always known it. Why do you think that the house Michael Saylor bought, he owns a house in New York, and he has all the deeds to the house. And he talks about this on one of the podcasts when he talks about Bitcoin. And he said that in the early 1900s, that house was worth less than six figures. It was worth like 50k or 60k or something like that. House in like Manhattan. Now, it's worth like 30 million in 100 years. There aren't that many more people. The human population since then has maybe doubled. Right? So it's not that the demand has gone up whatever amount of X that would be. From 100k to 10 million, right, is 100x. So his house was up about 30x. 300x, sorry. So we don't have 300 times more people on the planet since 1900. So why is the house 300 times more expensive? Because the currency that it is valued in has debased over 100 years of inflation of the money supply. Every rich person knows this. Poor people don't know it because they never have money. If you never have money, you don't notice that it devalues because you never had it. Yes, you know that your gas is more expensive and that a litre of milk costs more than it used to. But because you just make money at the end of the week or the end of the month and then you have to spend it because you have to live, you never learn how truly scarce assets are because you never own assets. You go to work, you get paid, or you're on benefits, you get paid, government handouts, you get paid, you get given money, but it's just enough money to get you through to the next paycheck or to the next round of benefits. And this is all done intentionally. JP Morgan in 2022 made billions. I can't remember the exact number, but they made billions in profit by just holding everyone's money. Because through their Chase Bank, which is like, I think it's the biggest bank in America for, the average person. If you're a burger, you'll know this. I don't know. I don't live in America. But I think the biggest, retail checking account or whatever is with Chase. If it's not the biggest, it's definitely in the top 3. I think it's the biggest. And they had $2 trillion, which Jamie Dimon, if you read what these guys say, in 2021, he said they're hoarding cash. You can go back, you can find it. They were hoarding $2 trillion worth of cash. And when I say hoarding, it doesn't mean that they're stealing it or whatever. It's customer deposits. But usually a bank can take those customer deposits and do whatever they want with them. They weren't. They were holding it in cash because he was foreseeing raising interest rates. And then come 2022, when guess what? The interest rates rise. They were then sitting on $2 trillion of cash, earning 5% on it in money market funds, buying government bonds. And so by buying those government bonds, they made, let's say roughly, we had high interest rates for about a year, and they're still high. So roughly 5% on 2 trillion. Do the math, right? It's not going to be exactly that, but you can get the idea. And they don't pay that to their customers. You'll know this if you have a bank account. You don't get paid 5% for putting your money into your checking account. You have to choose to take that money out and put it into a money market fund to get that 5%. The reason there's no financial education in school about things like taxes or interest rates or anything like that is because they want you to just have your money, put it in the bank, and they can go and get the 5%. They can give you 0 or 0.5% or 1%. And they keep the rest. That's the game. The game is keep the plebs financially illiterate, while we, the smart money, the wealthy, the rich, we understand that cash is trash, you want to own assets. So for that small period, less than a year, they took the liability of owning cash because it meant that they then had cash on hand to put into bonds to profit. At all times, rich investors, not the banks now, they're investors, want to buy assets, never sell them and use them as collateral. Warren Buffett, this is his entire investment strategy. Warren Buffett and Charlie Munger, their strategy was buy stocks, value stocks, value stocks. And eventually they bought growth stocks like Apple, etc. But buy stocks, right? Because the stock market goes up, on average, over a long time, 9% a year. So if you know that it goes up 9% a year on average, in the long term, you want to own those companies. Because you get paid dividends for owning the companies, which is real money. You get returns from the company if the company does well. And then you take those dividends and you reinvest those into more stock and you buy it more, which creates a reflexive loop where over time, stocks go up and they go up more. Because if the economy grows, which it always has, the market will grow because the market is the economy reflected. If the economy grows, the companies grow. Their profits grow. Their revenues grow. And as they grow, they get bigger. And as the money supply gets inflated by the Fed, the stocks go up even more because the money is less valuable. And when they get this, if you have $1 million, right? And it compounds at a rate of 9% per year, just go and run the numbers of how much money you would make over 20 years or 30 years. It's a lot of money. And so, because they know this, and they know that their wealth is going to exponentially increase through the power of compounding over time, they will then borrow against their holdings, borrow against it. They will take their $1 million portfolio of stocks and go to a bank and say, here's my collateral, give me $200,000. Don't worry, I'm good for it because my portfolio is $1 million. I have the collateral. Give me the shitty cash. I will do whatever I want with the cash, reinvest it into businesses, reinvest it into stocks, reinvest it into assets, or live off it. It's fine to live off it because if you've got $1 million and you make 9% on average per year and you can live off whatever, your living expenses are 60, 70, 80,000, just the interest, just the compounding interest on your assets will pay for your lifestyle. That's the game. They never sell their assets. If there is a downturn and they're a smart money manager, they will hedge them That's why there was a 60-40 portfolio for so long. 60% stocks, 40% bonds. Because the bonds typically do well when the stocks do bad. And that hedges. It reduces the risk in your portfolio. And here's where Bitcoin comes in. Bitcoin is going to become a part of these portfolios. But it's not like a crypto degen who puts all their net worth into Bitcoin. Which, by the way, I don't think is a bad thing. I think that's what I do. Practically, right? Sometimes a bit of cash, but mostly I want to stay in crypto because we're the new generation and we're okay with higher risk for the higher returns, right? At a certain point, that'll not be your outlook and you'll reduce the risk and you'll move into stuff that's a bit less volatile. But the idea is Bitcoin will become that less volatile asset over time as it gets adopted. But what these people are going to do with the ETF and everything coming is they now have a new form of collateral. The best, scarcest, hardest money in history. Bitcoin. Nothing is more scarce. Maximum supply, 21 million. Gold inflates at a higher rate than Bitcoin. And gold has always been seen as the scarcest asset. So, the game is to own assets and then use them as collateral to fund your life. Anyone who has done this with Bitcoin has outperformed. Bitcoin has gone up at an average of 200% per year since its inception. But in the past, let's say 6 or 7 years, when it's been a bigger, more macro asset, it's still increasing at well above the rate of the stock market. We're talking 50, 60, 70% per year. And so anyone holding their $1 million in Bitcoin for the past 6 years, again, go run the numbers on that. Right? If you invested in Bitcoin back when it was, 5K, well, it's up almost 10x. It's up 8x. So your million is worth 8 million in 5 or 6 years. Will you have spent 7 million to live in the last 5 or 6 years? No. You probably live off 100 grand a year. So your asset has paid for your lifestyle 10 times over. More. And so you're getting wealthier and you're living. That is the game. The downside volatility is only something that shakes out people who are financially illiterate. And for the big players, they're not going 100% into Bitcoin. It will start with 1%, 0.5%, 1%, eventually 2%, whatever. And it's part of a risk-adjusted portfolio to where they're exposed to the upside and the downside is limited because they don't go all in. They have other assets. So we're coming up to the point of a massive supply squeeze where there are not enough Bitcoin in the world for everyone who is going to need them. That's inevitable. It's hard-coded. Satoshi coded it that way. The game is not to sell your assets. The game is to move your money between assets based upon the market cycles, but always avoiding cash. Tether is a good example. If you pay attention, you'll know that Tether has 90 billion of market cap. That's 90 billion tethers. And they're backed 1-to-1 by $90 billion. Yes, they are, fudsters. People say, it's a scam, it's manipulation, it's a fraud. Most of that money that Tether has is tied up with Wall Street institutions. A CEO of one of the biggest hedge funds was talking about how much he likes Tether and how great they are and how much money they have and how many T-bills and how much of government bonds they own. This isn't hidden. This is known. They own them. They're one of the biggest owners of treasuries, short-term treasuries, on the planet. And so everyone who used to talk about, they used to use this as FUD. They would say, look, Tether's not backed. Because they would see Tether's attestation of their balance sheet and it was, look, they don't hold cash. They hold cash and cash equivalents. That's the point. You're not supposed to own cash because cash doesn't earn anything. Cash equivalents is commercial paper, short-term bonds, short-term treasuries, because they earn a yield. And Tether made billions of dollars last year by holding the 90 billion. Again, same thing. They ran the exact same playbook as JP Morgan. You go to Tether, you give dollars, you get USDT to transact in the crypto ecosystem. You don't get any money. You don't get any yield. You give your dollars, you get your tether. You go off and play with your tether. They keep the dollars. They put the dollars into a money market fund. They make 5%, and they make billions of dollars. 2 billion they made last year. They're one of the most profitable companies in the world because they understand money. Rich people do not sell assets. They rotate, they hedge, they do not sell. They do not go into cash. They don't sit with a bunch of dollars under the mattress because those dollars are worthless. They are deflating, or devaluing, I should say, debasing, inflating as the money supply grows. And so you have to approach it the same way. You have to take a long-term view about your assets. Your goal is to accumulate more things, more scarce assets, because fiat currency will always trend towards zero because it is essentially unbacked and can be printed out of thin air. And you give any centralized authority the ability to print money and they will print it. You've got Lebanon, Turkey, Argentina, Venezuela, and others that are already fucked. And you've got the rest, the pound, the euro, the yen, the dollar, that are on the same path, just at different rates. Wealthy people don't sell assets. They accumulate assets, they borrow against them, they live off the compound interest, they take the borrowed dollars to do more productive things with them. They don't leverage up 100x. They put $1 million in, they borrow $500,000, they use that $500,000 to make another, whatever, 300,000 or 400,000. They live off the rest. It reinvests. It grows. Their pie grows over time. They make more than they spend. They have compounding interest over time, not 1 year, over 10 years, that is greater than their assets and their liabilities of what they spend every day to live. And that's how they survive. The rich get richer because they are financially literate. The poor stay poor, but they don't stay still. The poor are actively getting poorer, as is the low class and the middle class. The lower class just never have any chance to even get on the ladder because they have no money. They have to live either off government benefits or live week to week, month to month. The middle class make money, but they don't make enough because they're saddled up with student loan debt, car debt, mortgage debt, debt, credit card debt. So they can never get out of debt because they don't earn enough, because they work jobs. And the job is only going to make them 100k a year. Cool, but their liabilities are over 100k because they have all those debts I talked about. And that's how you see this wealth divide. And what we are living through is the greatest wealth transfer in human history, and crypto is at the forefront of it. Don't lose sight of that.